It's that time of the year when we look back at 2016 and try and predict and get for our viewers what would 2017 hold in store. And every time this year, we speak to two very special guests. Need no introduction, Amay, Hattangadi and Swanand Kelkar in our studios to talk about Simhavalokana 2016, a throwback to 2016 and learnings which can be applied for 2017. Guys, great having you as always. Thanks so much for joining in. Much appreciate that we do this annual feature every year on ET Now. Now, 2016, Amay, what has it, in a nutshell, what has it kind of taught you? Because I was looking at the note, and one of the things that comes out is that in one of the points you guys have mentioned that there are certain pockets which will ride over a period of gloom that has come into the markets. I'm presuming that you mean that the near term of markets 2017 also will have a bit of gloom.
So 2016 has clearly been a year where there have been events which people clearly did not predict, whether it was Brexit or US presidential election. What we are trying to make in this point is that there have been some themes which worked regardless of the macro uncertainties, regardless of the event uncertainties that we saw in 2016. And looking into 2017, we think that it's going to be a challenging year because we are all keenly looking forward to see what happens in the budget.
Right.
We are keenly waiting and watching when GST gets launched.
Right.
So clearly there are a lot of events in India that we are looking forward to see how they play out. So I would not use the word gloomy, which is what you use, but I'd clearly say it's a challenging year as we enter 2017.
Okay, and just taking a leaf from that before we get on to the key learnings, and there are a bunch of them that I want to talk about, Swanand. But Amay is right, it's an eventful year. I mean, he mentioned too, a lot of people lay a lot of emphasis on the UP elections as well. Then, of course, Donald Trump takes center stage. So the first half of calendar year 2017 is filled with a lot of these events as well. Do you expect the markets to remain volatile in the first half, or is it difficult to predict that right now?
So the one thing which we have learned it the hard way in 2016 is, one, you can obsess over the binary events which are going to play out.
Yeah.
But even if you have perfect vision and you are able to predict the way that event will turn out, you'll most likely get the market reaction wrong. Right. That's what happened with the Trump win, right? I mean, the statistic we have quoted in our report is that the Dow Jones was up all 5 days during the when the US election results were declared. The first 2 days, the index was up because everybody thought Hillary Clinton is going to be a shoo-in. And the next 3 days, the index was up because everybody thought Trump is great for the markets. So even if you get the event right, even if you predict what the event is going to look like, making a bet on the market based on the outcome of that event is always very tricky. So as a rule, we have always shied away from betting on events. And I think we would also advise your viewers to shy away from making bets on binary events.
Right.
Having said that, the one line which I like about just like nature, even markets abhor a vacuum. Right? Markets always love to look up to and look forward to an event.
Right.
So there is always something on your calendar which will say UP election results, budget today, monetary policy today. But investing over a longer time horizon happens irrespective of these events. These events come and go, and you feel or you talk about them for a few weeks maybe. If you take the Brexit example, it was just 2 days before markets just marched on the way they did. So yes, there will be events, there will be volatility surrounding those events. But if you're able to ride out this volatility, I think that's the right way to invest, rather than just to obsess over the next event and how the markets are going to react to it.
Okay, so let me then, since we're talking about events, let me talk about the learning number 2, and which is betting on binary events, something that you guys briefly spoke about, and you guys are saying it's not a great idea. The problem though, Amay, is that we've 2 key binary events in the first half of 2017. One is the budget, and I call it a binary event because everybody wants this budget to be a good one after demonetization. So either it will be a good budget or it will be a bad budget. If there is a capital market scare, then it will, from a market's perspective, be a bad budget. Then the UP election, and from a market's perspective, again, the ruling party should either have a toe in or should be winning a whole scale. So these are binary events. How do you think the market approaches this? Because you're saying you don't want to bet on them, but you will have to take a stance based on what the outcome is on these events.
Yeah, I think we're not going to bet specifically on these events. In fact, we would actually at times try and see if we can take opportunities against the markets. If the markets are getting too exuberant, expecting too much from the budget, we may actually love to play contrarian. Similarly, if the markets are, taking a particular view on an election. Many a times, so we try to avoid taking, taking a bet on these events and trying to figure out which way these events go, because I think time and again we've learned that trying to bet on these events does not work. So I don't think budget day is the only important day. Right. So on 1st February, when the budget is announced, people may take a view that this is a good budget or a bad budget. But I think the real story is going to play out as the year progresses. Right. So let's assume at this point of time, people are building in a lot of expectations that there's going to be a decent fiscal stimulus in the budget because the economy is going through a growth shock. But I think the judgment day is not 1st February. Maybe at this time next year, if we were to meet again, that's when we will really figure out whether the measures taken are actually helping the economy, whether growth is reviving or not. So I think, we are again laying too much emphasis on what's going to happen on 1st Feb. That's not going to work. 1st Feb is one event that will come and go. But more importantly, I think we need to see how that, whatever is announced on 1st Feb, what impact it has through the year.
Okay. The learning number one, Amay, is that it's turned out to be a year which has been another for pollsters. Now, you base this on the two large polls that have happened, right? Which is both Brexit as well as Trump. Now, why is that a key learning from a market's perspective?
Well, I think we lay a lot of emphasis on what various pollsters are saying, right? Because the markets are constantly watching what the polls are saying and try to take a position in the market based on those polls. And we are not recommending taking either side, right? Because we also make a point that sometimes you get the event right, but you get the market movement wrong. Right. So we are not saying that you need to take a view on, like you say, UP elections or whatever, and say that, because even if you're right, you may be wrong on markets. So I think, one, we are saying don't get carried away with what the pollsters are saying. And second, we are saying that even if you get that right, the event right, you may get the market outcome wrong. So it's best bet not to bet on those events, and I wouldn't want to see 2017 as a series of events, because every year there are a series of events that happen, right? And 2017 in that sense is no different.
So I want to thus tie that in with your learnings number 8 and learnings number 9, and one of them is that beware of the echo chamber. I'm just kind of usually using that term, and then of course the merits and demerits of forecasting. So I want you to tie it in with 2017, and the reason I bring up this point and this learning is that my echo chamber is filled with people who, while they are not on cam, are saying that demonetization has hit and will continue to hit the economic growth in a really big way, and markets will not come back with any kind of positive surprises for the first 9 months of this calendar year, if not more, or 2017 essentially. Now, do I need to get rid of this echo chamber? I'm asking you because do you have a view which is slightly different than this?
So I'm basing my view on what was the consensus saying at this point of time, right? So if you look at consensus earnings for next year, that is still in the range of about 18% growth. Right. So clearly it means that the consensus earnings estimates from the sell side have not adjusted well enough for what seems to be a pretty large growth shock. And that tells me that it's very difficult for analysts or people from our community to make non-linear forecasts into the future. So when you have a growth shock, when you have an event which is not normal, then it becomes very difficult for someone to say that earnings next year should be what, -20, we don't know, right? So most people still make linear adjustments to the forecast that they've already made, and are very slow to make these adjustments.
So are you saying it'll be worse then, or it could be
I don't
worse?
know what it is.
You don't know,
because it's a non-linear event. But what I do know is that the changes which have happened so far are extremely gradual and linear. And I don't think this event has been one which will lend itself to a gradual and linear adjustment.
So are you guys positioning your portfolios for a shock that could come in, or in terms of earnings, or are you right now working with a slow gradual downside, if you will? Either.
So I think as Amay said, right? I mean, if you looked at the consensus expectations, FY17 earnings growth is about 11%. FY18 is about 18-19%. And there is one set of opinion on the street which says that even if 17 is really bad, 18 is going to bounce back because there's going to be a great base for FY18, and hence we should look through the FY17, FY18. I don't know what the shape is, but I'm going to stick out my neck and say, if you look at FY16 and if you look at FY18 earnings, the 2-year CAGR will be single digit at best. So what people are currently putting at 11 and 18, I would say it would be a single-digit CAGR. I don't know if 17 craters and 18 bounces back.
Sure.
But when I'm thinking about a 2-year CAGR, I don't see how we can get to double-digit earnings growth over those 2 years. Having said that, ours are, I mean, we run growth portfolios and we run large portfolios, right? And what happened was probably an overnight event.
Right.
And you cannot reorient portfolios overnight from what you were running them with. I don't think we are going to jettison our investing style.
Okay.
We are going to be growth and quality, and hence one of the points that we mentioned here is we'll keep looking for pockets of growth.
Okay.
And there will always be pockets of growth.
Of course.
And the example which you used was to borrow something from cricket, that when you're watching a test match, let's say 10 years ago, and India was 100 for 5, you generally lost all hope.
Yeah.
And then VVS Lakshman typically did a rescue act.
Right.
So I think we'll need to find out those areas of those bright spots somewhere. And we mentioned a couple where you could position your portfolios. If you look at it since 8th of November, what's done well in the market is what we internally call 1 minus demonetization. Everything which is not affected by demonetization has done well.
Right.
Right. Let's say if you had 5 suppliers and 10 customers, and you did not have to interact with a large number of people, irrespective of what you bought or sold, that stock has outperformed because of the fact that you don't need to deal with cash and all those things. Right. It was a very secluded kind of a club, kind of a business. So I don't think that is a strategy right now. That is a reflex that people have gone into stocks which are not benefiting from demonetization. But if we remain growth investors, we're going to keep looking out for those growth spots, and there will be some.
If I look at your large portfolio, you guys are certainly overweight on consumer now, and distinctly much higher than what the MSCI allocation also would be. Why is it that you are so bullish? Again, it's a pocket where it's difficult to predict how the growth will shape up to be like. I don't think even companies can kind of confidently say how 2017 will be for them.
So clearly, when we look at consumer in India, we look at it as a combination of consumer staples, consumer discretionary, and the consumer lending segment within financials. So when we say we are overweight consumer, it is a combination of these sectors, and this was one growth engine for the last 2 or 3 years, right? So at a time when the corporate capex cycle was anemic, when there was surplus capacity in India, Indian industry was operating at about 70% overall capacity utilization. There was surplus capacity. So clearly, the bright spot of investing was on the consumer side of the economy. So consumer growth was decent, consumer lending was picking up, and this is where I think we have to wait and see what the impact is going to be.
But what would your top bet be? I mean, in terms of within these pockets, where is it that you would be comfortable about earnings growth sticking?
No, at this point of time, I'm saying it's very difficult to predict what the earnings growth impact is going to be.
Sure.
So we'll have to wait and watch. In some cases, you may see it all front loaded. November, December may be the worst, and then they may see a turnaround. Some may see it in a more prolonged way.
Okay.
So I think we'll have to wait and watch.
Because it's still early, Niraj, right? Because we haven't had even the first clean high frequency data point after the event, right? Which is the month of December.
Right.
You start getting those numbers in the first week of January. Even the November numbers had their own quirks to it, right? There was inventory filling up. The first 8 days were fine. There was Diwali spillover. So the November number in that sense wasn't clean. Only in December do we get to see.
Sure.
And in the absence of hard data, it's only anecdotes which are flying around. So it is you talking to your maid or your driver and then trying to figure out what the impact of the demonetization is.
Trust me, a lot of people are doing that.
Exactly. So we are, from a data standpoint, we are in a no man's land right now, right? I mean, we understand that some of the growth stocks that we own will have a lower growth than what we originally expected.
Sure.
But I don't think
proven otherwise.
Exactly. I don't think we have an idea on how bad it is.
You know, one conditioned response, Swanand, has been that when the US FDA troubles heighten, distance yourself from pharma. Yeah, I think that's going on right now as well.
Absolutely.
And if I look at your portfolio, you guys are underweight pharma as well.
Absolutely.
So there's a bit of a consensus out there. You guys are okay with distancing yourself from pharma, even though the valuations have come off.
Sure. So when we mentioned about not following templates of old, we were using an old template of volatility which India has followed, right? When there is volatility or when the markets are going through a tough phase, the rupee reacts very quickly. I mean, be it early 2012 or 2013, when those episodes, Tipper tantrum as it was then called, the rupee lost 10% in 1.5 months. That hasn't been the case this time around.
Right.
Rupee has been remarkably steady.
Yes.
In fact, since November, it has been one of the best performing currencies. Even through the year, it's done fairly well. versus its peers. So the response in a moment of volatility used to always be, if the rupee is going to depreciate, let me buy tech and pharma because they are exporting sectors and hence will benefit from a weaker rupee. This time around, the rupee hasn't weakened. And plus, both these sectors we think have their own problems. For tech, I think growth is an issue. And for pharma, the US market is no longer as big an opportunity size as it used to be from an individual company in its portfolios. So if you look at, I can't name names, but if you look at the top 4 pharma names in the country, past 2 years stock price return has been 0. Right? None of the top 4 have performed at all.
Yes.
Whereas 2014 was a banner year for these guys. Right. So the trend was playing out even before this event happened. That everybody was having challenges converting their promising pipelines into actual revenues for a variety of reasons, and that was reflecting in the stock price.
There is a learning number 3, Amay, which, and we kind of briefly spoke about it, beware of a consensus trade. Now, this is not a new idea, frankly. A lot of people probably have it, and I think we learn about it every year.
Exactly.
My question to you is, where is it that you are anti-consensus right now?
Many of the Indian players are trying to reorient their business, you know, with the way technology is moving forward. Many of our Indian companies have been used to doing business in a particular linear way, and that's what they're trying to change their portfolio. But I think in terms of more than anti-consensus, we are out there trying to seek pockets of growth, which are different, right? So one of the themes that we've always spoken about has been relating to pollution.
Yes.
And that is a theme that played out very well in 2016, despite all the noise, despite all the macro concerns. So that's a theme that played extremely well, right? And this is because this is because the problems relating to pollution have kept increasing. So so companies in the city gas distribution space have done extremely well.
Sure.
The other anti-consensus bet probably at the beginning of the year was in the oil and marketing companies, right? Because people have typically looked at the PSU oil and marketing companies as short-term trades. You know, you bought it at a particular price, you sold it 20% higher, and you were done and you were out of the trade. That was the old template. And I think that has also changed in 2016, where people have realized that the earnings of these companies have continued to improve quarter after quarter, that these companies have raised or moved their prices in sync with movements in oil prices, and these companies have gotten re-rated.
Right.
So clearly these two have been trades, you know, which at the beginning of the year were not consensus.
Let me take learning number 7, which is themes that work even in challenging markets. Swanand, now again, pollution reduction, so on and so forth is something that has happened there. What do you think is a theme or are themes that will continue to work even in challenging markets? And we are working with the presumption that the markets will remain challenging for calendar year 17.
Sure. So when we say challenging, I think we need to caveat it with the fact that this is going to be challenging from a growth standpoint, right? I mean, what we thought was the growth inflection finally coming here after 3-4 years of tepid earnings. That definitely has gotten watered down.
Right.
So the challenging is from that standpoint, and within that we feel one is obviously, and we talked about it on your show earlier, is about pollution and pollution control and stocks or beneficiaries from that trend, and that they're benefiting. I need to make this point that I think they're benefiting from two things. One is obviously the regulatory standpoint. From a regulatory standpoint, people are being now pushed with all the talk about pollution, etc., being pushed towards these stocks. And second, even investors like us are now focusing on something that is known as ESG, environmental, social, and governance
Which I think
issues.
you've been doing for a while as well.
Absolutely.
Right? Last year
so
we spoke about
responsible investing. So I think these are also, if you look at the city gas distribution stocks, they have been re-rated very smartly all through 2016. Partly is because of earnings growth. They're delivering growth, no doubt, but the re-rating has also come from money such as ours getting into those stocks. So that's one. I think the big trend which has happened, and we have been talking about it for a while, is the way India is consuming data. If you looked at, so there's been a new entrant in the market, and for now the data consumption is free, and from the numbers that we see it's as high as 25 gigabytes per person per month, which is a huge number.
Yes, it is.
In terms of data consumption, and that on a 60-70 million user base is a massive consumption of data. We will have to wait and watch that when this offering is priced. Currently it's free.
Right.
When it's priced, how does it pan out?
Right.
But the trend of India consuming more and more data with the enabling environment for, let's say, even the handset or broadband being in place, I think a lot of content makers will be a space to watch out. They are currently very small niche kind of plays, but that is something which over the next few years will be very interesting, because we as Indians, I mean, apart from cricket and Bollywood, we don't have any pastimes, right? I mean, we want to be entertained.
Yes.
If you think about the kind of original content which is generated per capita in this country, be it movies, be it TV serials, be it business news channels, it's mind-boggling. So we just create a lot of entertainment. We are not an outdoor country like, let's say, Australia, where we go and surf. We like to be entertained, and I think that's a trend which will endure for a while.
Is there enough available though in the listed space for a fund as large as yours?
If you look around, there are some stories which you can at least get into in a small way.
Okay.
But you could look at it even from a telecom company standpoint. Currently, we don't have any holdings there.
Right.
You could look at it more even from broad media companies.
Sure.
So this trend is interesting. The winners are not obvious on day one, but I think there will be beneficiaries of this space which will come out over time.
Okay. Amay, I want to introduce a learning number 11, if you will, which is what will happen to the most talked about themes. And you know, I don't know if you guys have done work there. I'm throwing this out of the blue at you, but one of the things that we hear the most in calendar year 16 is blockchain or artificial intelligence, so on and so forth. You know, and everybody wants to explore what kind of investments can happen in this space. Have you guys been able to do some work there? And is there some possibilities in the Indian listed space for that?
Well, there aren't too many possibilities in the Indian listed space, but clearly there are going to be implications, right? So depending on blockchain, robotics, machine learning, artificial intelligence, all these are going to have implications for many Indian companies over time. And I think we need to recognize that fact, whether it is the Indian IT service companies, what does some of this mean for them, whether it is for Indian manufacturing sector, which is labor intensive. So I think these have very important implications for the sector in terms of threats, if at all, on what it could mean. But at this point of time, there are no outright plays which are directly involved, I would assume.
Okay. Can't wrap up the discussion without talking about one of the largest spaces, and that is pure play banking. Yeah, PSU banks haven't quite done what people expected at the start of the year. Private banks, ho-hum. What do you think is outlook 2017?
Well, I think in 2016, what we saw in the financial sector was clearly a binary division, right? You had the consumer lending engine, which was doing extremely well, starting from microfinance, gold finance, automobile financing, housing. So you take every segment of consumer finance that was doing extremely well. And then there was the corporate lending segment, which was extremely anemic and grappling with NPL issues. So it had become a very it was literally the financial space was divided into two segments. What we are seeing now is that while there is a lot of focus on the consumer lending segment and what demonetization will do to the consumer lending segment, I think people are not adequately recognizing the fact that probably the corporate lending segment has been even more postponed into the future, the revival, right? Because if you have a growth shock which affects consumer sentiment, then corporate India is going to take that much longer to make further new investments. So the corporate lending cycle is getting even more pushed out into the future. And I think the consumer lending segment, with lower interest rates and with many players, will start seeing some revival in the months and quarters to come. But so I think financials is a large portion of the market, and you cannot ignore it. Within the consumer lending segment, we'll have to kind of now figure out, which of these players will continue to grow, which one had a large dependence on cash collection. So I think we'll have to make some of that granular distinction. But I wouldn't say that the consumer lending cycle is done for now. I think it probably has more legs to go after a pause.
Okay. So last piece on the show, Swanand, and I loved it. I tweeted about it as well. A couple of lines out there that, find some time to enjoy a sunset, smell the flowers. Odds are it'll make you a better investor. Has it helped you guys this year as well? Have you done a lot of it?
Not a lot of it, but we did a bit of it. So we switch off and we get away time and again. And it generally helps. You come back refreshed. You come back with your batteries really charged. Otherwise, it's an animal which can be all consuming, right? If you have tickers on your phone, and at 9:15 in the morning you start getting panic attacks, I think you really need a break. And that's what we keep doing periodically. We take some time off, go to the mountains. That's my favorite place to go to, and that ensures that you don't have network, and it helps give you a sense of detachment. And I think sometimes you flatter yourself by thinking that you are indispensable.
Yeah.
That if you don't turn up at office, this channel is going to shut down. It's quite unlikely.
Okay, let not my promoters listen to this. But yeah, I'm told Amay, of course, came back from a holiday, so I'm thinking he's got his batteries recharged for sure for the new calendar. But great having you guys. Thank you so much. And I repeat, we love doing this piece with you at the end of every year, as also all the others, but this one specifically. So thanks so much for sharing this piece with us and your intelligence with our viewers as well. And wish you a great 2017.
Thank you so much.
Thank you.
Wish you the same.
Well, that's the Morgan Stanley Investment Management view on Outlook 2017. A bit of a throwback into 2016 and key learnings as well. Hope you enjoyed watching the show as much as I enjoyed doing it.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.